Hello and welcome to Policy Watch, your packed snapshot of the week's biggest business stories, their context, their relevance and policy impact. I'm Govindraj, Ethiraj. India's economic growth measured in GDP was up 7.3% in the second quarter of the financial year as compared to 7.1% in the first quarter of this financial year versus 7.6% for the corresponding quarter last year. Now, the increase in the July-September or second quarter this year was led by agriculture, which grew 3.3%, and manufacturing, which grew 7.3%. Now, the question that we are asking, however, is what will the next quarter in the full year look like as we assess the full impact of the government's move to demonetize the rupees 500 and rupees 1000 notes? More specifically, what sectors could be affected more in the coming two quarters and what could perhaps prove resilient? And indeed, what might be the moves we should expect from either Mint Street or the Finance Ministry to lubricate the economy? To discuss this, I'm joined by Brinda, Jagirdar, Economist, and Anish Chakravarty, Lead Economist and Partner at Deloitte. Thank you both for joining me. So first of all, let me ask you a more academic question. Have you ever seen something like this before, where you're trying to grapple with almost non-existing data points?
No, this I think is the first time, not only for the country, but I think even in the world.
In the career of most economists.
Of course, and even in the world of such of this magnitude, of this scale, I don't think any country has seen something like this.
Right. Anish?
It's been seen in India, as we know, in the late 70s. Globally, if you see in the EU specifically, the 500 euro note was also demonetized. But to the extent of what has happened and the swiftness with which is
or for that matter, the actual conversion from the French franc and the marks to the euro in the 2000s.
That's right. That's right. And it was a gradual phenomenon. So the swiftness of what has happened in India, I think that's perhaps unique.
And also, I think when it happened in 1978, as Anish was saying, it was only about 1.7% of the money supply that was affected.
Right.
Now we're talking about something like 86% of money supply.
Right. So the question that we're trying to ask now is that we're seeing reports of a whole bunch of sectors being affected. It's agri-produce, consumer products, cars, two-wheelers, sales falling, companies pulling out ad spends because they know consumers can't spend, consumers in turn not consuming, including in e-commerce because they're not paying cash. How do we compute all of this and what could the impact be?
This is very clearly in the near term. This impact is because, like I said, 86% of the money supply has gone out of circulation. It's taking time to get replaced. So but then it's also a different world we are in, wherein we have more than 900 million mobiles, and we have how many 90 crore debit card and credit card and rupee cards in circulation. So online transactions. So it is a different world. So therefore, this kind of the change that you're talking about, so many getting affected, that is, I think, the whole impact as well, because it is so much.
Okay, Arish, let's then try and construct it a little differently. We're saying, so we know what GDP is made of. To what extent, from what you see in terms of slowdown numbers, which are very visible anecdotally, otherwise I'm sure in numbers too, like car sales and auto sales for the month of November, where do you see the two intersecting, and what is the impact that you're assessing?
Sure. So from a GDP perspective, let me start with two sides of the GDP. So one, there is the growth side and then the expenditure. And I'll link it to Q2 from what we've seen. If you look at the subsectoral numbers of Q2, almost all have performed weakly compared to Q1. And in fact, some of the numbers are much weaker than, even if you look over the last 4 quarters. Manufacturing, electricity has almost halved. Construction has marginally gone up. Agriculture, we know, has gone up because of the winter harvest. But then if you look at the services side, trade, hotels and communication, and financial insurance services and real estate. Now, these are the two areas where Q2 numbers have already gone down by roughly about 100 basis points. Q3 numbers are expected to get affected purely because of this phenomenon. And we must remember that the quantum of this in services and the impact of this from an overall GDP perspective is quite large. So therefore, there is going to be a negative impact. I think we are all clear about that. I think to the extent of what that negative impact would be, that's crystal ball gazing at this point. I think there are reports saying 100, 200, 300 basis points. I personally do not agree.
3.8% growth and
exactly.
And there are median of 6.5%, which was the Bloomberg survey for next quarter.
Exactly.
In any case, it's lower. I think that seems to be a given.
I think that is the only certainty at this point of time. But saying anything more than that is pure crystal ball gazing.
Okay.
Even before this whole demonetization incident, we had already seen growth slowing. Capital goods was in negative territory for a long time.
Gross
exports
capital, fixed capital formation.
Yes, and fixed capital formation only now in the last 2 quarters has picked up a little, but it has been in negative territory. So the slowdown that we are seeing has been there in the economy for a while, especially in the second half.
But we were still on target more or less for 7.6%?
Yes, but that will get a little pushed back now. But as you said, not to the extent of 3.5 or something like that. We'll say there would be a small correction in the GDP, but it would come back. impact, if you look at the PMI data, I think that's the first data set which has come out now after the demonetization impact. So we can clearly see that both domestic or new orders as well as export orders have slowed down, and more sharply in the case of domestic sales, in the domestic new orders. But input prices have fallen much more than output prices.
Right.
So that's helping.
So let me ask another question, which is, let me put this to you. So there is spending and there is propensity to spend. So the understanding here could be that we have the propensity to spend but don't have the money, and therefore decisions could get pushed, and sometimes of course they get lost because they get pushed so far. Now, what is your sense? I mean, assuming let's say in 2 months our propensity remains as it is or was, and the means to spend comes back into our hands, which is cash for those who want to do, will things accelerate and make up for what we've lost?
So there's a difference between the short term and the mid to long term, right? Now, India is a domestic demand driven economy. There is absolutely no doubt of that. People love to spend, okay, and that drives the economy.
Yeah.
Now, when you disrupt that to the extent of what has happened, there is going to be a disruption in consumption expenditure, right? So consumption expenditure will come down. Now, again, I'll link it back to the GDP numbers, and if you look at the expenditure side, consumption expenditure has partially gone up from Q1 to Q2, but Q3 that's expected to take a hit. Okay. Now, in the long term, assuming a lot of these discrepancies.
So when you say long term, you mean 6 months, or even longer?
I would actually put it FY 17-18 at this point, right? I would not count Q1 of FY 17 too much because I believe that in case GST happens, there is going to be some implementation disruption, so it's not going to give you the overall trajectory, but from Q2 onwards, right? So that's purely on the consumption side. Now, typically we know the sectors which are going to get affected. We know real estate is going to get affected. Trade, hotels, communication, already we've spoken about. Financial services is going to get a boost, but in the short term, there is going to be an impact. More importantly, consumer durables, consumer non-durables, clearly going to get affected, right? And it's going to take a while for it to come back. I think the question linked to this is on the broader economic set, and we spoke about gross capital formation. Q1 negative 3.5%, right? That has come down to about 5.2. So the impact on capital goods, consequently the impact on exports, I think these are secondary or ancillary effects which need to be understood in a much greater detail than perhaps we are focusing on right now.
Right. Yeah, go ahead.
About exports, let me just add one, that yes, it has been impacted, but then there was a CRISIL report which I was reading, which says that exports of Bangladesh, Vietnam, China, exports of these countries have gone up. So we need to look at not just the domestic economy, we need to see how we are competing with our other countries and push up our exports. It's not just domestic reasons that is putting down exports.
Right. So let me come back to the question that I put to you earlier, Ani. So I was trying to ask that, if we look at the components of the economy that have been affected, and some components possibly we didn't predict. At least when we look at reports, we look at, let's say, slowdown at agri-produce markets, we look at the difference between crashing prices of wholesale vegetables or wholesale produce. So how do we try and estimate what could be the cumulative impact of this? Or on the flip, could there be something that is still missing, both on the positive as well as the negative, which could contribute to the overall number that we're going to see at the end of this financial year?
I think it's extremely difficult, Govind, to really, again, estimate and predict what the overall net impact is going to be. Okay? My estimate, or our estimates, roughly look at about 40 to 60 basis point. Okay, as we spoke about, there are other estimates as well. On the propensity, I'm going to link it back to the question you asked earlier. So the willingness to spend is there. In the short run, the disruption is there that you cannot spend. As I've mentioned, from Q2 17, I believe a lot of this will get sorted out. But anything further than that, and we know the sectors, by the way, which are going to get affected, but anything further than that, to say what is the quantum of that impact, I think is extremely difficult at this point of time.
Okay.
Again, it's not just a domestic issue, as Brinda rightly pointed out. There are a lot of exigencies as well. We are looking at the Fed rate hike coming up in December. So there's going to be seemingly a capital outflow out of India, right? That is going to have an impact as well. So from the RBI's perspective, I think a lot of people are saying that the rate cut is a virtual certainty. But even if you say that, a lot of that, to me, needs to balance out with the Fed Act rather than what's happening domestically.
Right.
Liquidity, they've already looked at.
Right. So, and I was going to come to that. So, what could the government or the Reserve Bank do, if at all, to lubricate this part of the economy? So, yes.
Let me start with what you said. What we are missing? I think we are missing out the impact of the rural distress. That is not getting fully captured in our macro data.
Because of demonetization, or even before that?
No, mainly because of demonetization. So I think that is something which needs to be addressed on an urgent basis, because if we see CPI numbers have come down, the urban inflation has come down, but rural it's really in bad shape. So I think we need to address that quite quickly. And on the positive side, I think it's never going to be business as usual. We are going to see now even the rural economy become more savvy using technology and coming on to e-platform for agricultural produce markets. And I think that's that. And even in the urban areas, people starting to use more RuPay, Buddy, MobiKwik, all those applications. So that's going to be a big difference.
So you're saying the cashless part, which we're going to talk about in a later segment, is going to really make up in some ways and start sort of lubricating the economy and where need be. Okay, but let's come back to the steps now. So interest rate cut, as is being now speculated, as a 25 basis point is almost certain. Is that something that you concur, or?
I would still say high possibility, but you cannot say virtually certain.
So even if it were to happen, what could it really do? I mean, will it really sort of, massage all the massage all the wounds and so on? Or?
No, I don't think it's a balm for all.
Yeah,
It is something which is going to have an impact because clearly banks are flush with funds at this point of time. Most of the small savings accounts are flush with funds. So this is something which is squarely addressing that aspect of it, right? Earlier also we've seen, even if the RBI had gone ahead with the rate cut, the transmission mechanism wasn't working very well. This is something which squarely addresses the transmission mechanism.
And how could that turn out this time?
Well, this time it's purely at the local, at the banking level, right? So it's not at the RBI. So even if the RBI cuts rates, I think the transmission virtually is a certainty, purely because of the banks being flush with cash at this point of time.
So monetary or fiscal, what could the government be doing, or should it be doing to maybe make up for the damage caused by demonetization?
Rate cut is one, of course. And
will that achieve some of those objectives?
It definitely will. First of all, it will have an impact on expectations. And look at the rates. The market rates have already come down. The GSEC rates are already coming down, and banks are cutting their own rates. In fact, they've cut quite aggressively, and now they're holding back. But what is going to really decide the quantum of the rate cut? It would depend on inflation. Domestically, we are seeing CPI price coming down, but the rupee is weakening and oil prices going up, so that could have again a negative impact. That could sort of offset. So I would say definitely 25, maybe even 50, depending upon how the external economy impacts us.
So there are a lot more things to think about than purely domestic from where we started, though we are a domestic economy, and hopefully things will get evened out. But at this point, the government is saying that show us the data or wait for the data to take more concrete decisions on where the economy will land. Let's find out. Thank you so much for joining me. We need to go in for a break. Coming up on the other side, digital and cashless is what we've been talking about. Let's find out what it really takes or will take to make India a truly cashless society. Stay with us. Welcome back to Policy Watch. Even as India grapples with the pain of demonetization, an increasing number of residents are seeing the benefits of using digital payments, whether it is through the internet, mobile banking, or newer methods like the United Payment Interface or UPI. While the moves are in the right direction towards a healthy cashless society, there are challenges in between. One is that the unorganized sector, which could include small enterprises to indeed the sabziwala you buy your vegetables from, do not have the ability to receive payments, assuming you as a giver are ready. Now, the challenge, it would appear, is technology, infrastructure, and culture. So to what extent can we reduce dependence on cash, and can we do so? Let's look at all these three areas a little closely and ask, what will it take for India to achieve a truly digital cashless society? To discuss this, I'm joined by Deepak Premnarayan, President of the Indian Merchants Chamber and also Chairman of Rand Bank of India. I'm also joined by Rajeev, Arora, Chief Operating Officer of FINO, PayTech, a banking correspondent which has touched tens of millions of users across the country. Thank you both for joining me. Mr. Premnarayan, let me begin with you. So first question is, many of your members, while they belong to the unorganized sector, particularly in manufacturing or for that matter in services, deal extensively with the unorganized sector. So there is a lot of cash interface happening. What has their experience been in the last few weeks?
Well, I wouldn't say that many of them are the unorganized sector. We, of course, have almost about a 2.5 lakh member base in terms of reach, and 80% plus is SMEs. But yes, there is that component which is there. Of course, they've been hurt. They've been hurt, and how do they see the next 3 months? They see the next 3 months definitely improving. One, personally, other than the business, they are excited about this change. So that is where it is. They are willing to carry the pain, but many of them have been very innovative. I mean,
why are they excited about it?
They are excited about it for the simple reason because it will reduce a whole lot of hassles. Now you take, for instance, today, you take RTGS. That operates, I'm just saying the other side of it, it operates for a few hours in a day. Imagine if it was to operate for 24 hours a day. And how would that happen? That would happen, let's say, if you've got companies like Clearinghouse, you've got companies like FINO on the deck over here, or you got people like, I'm saying Google for that matter, or you take SMS, you take WhatsApp. Now imagine if I sent you an email, and with that email I was able to tag my money, or with WhatsApp I was able to tag my money, what that would do to the payment system. And today, very rapidly, I'm going to come back to this because today, very rapidly, I'm finding that even, let's say, the smaller people like laundries, etc., who would accept payments only by way of cash earlier, today, I mean, through the e-wallet, they have transformed almost instantly. I was being interviewed yesterday by another channel, and the anchor there said that her servants had been set a deadline, and the payments are now being made, salaries. So this is, I find that the Indian jugaad is such that it's happening extremely fast.
Okay.
It's, will it take 2 years? Of course, maybe it may take 2 years to cover the entire spectrum.
Let me come back to the SME part, which includes the members that you're. How are they coping with this current problem? You're saying they're excited because they feel that things in the future, which is digital, is good, right? But they're also dealing with a world where cash is an important component. A lot of that cash is unaccounted for, or is there because people don't want to pay tax.
Yeah, so as I said, temporarily they've been hurt. And what's going to happen is that in the next month or so, I was talking to some of the people in the head of the Bombay Industries Association for that matter. They are our members. And they feel that business will start picking up in the next 30 days. But by the time it actually picks up, it's going to be about 90 days. But will cash totally disappear? Of course it won't. Of course it won't totally disappear. But what's going to happen is that you're going to see all this will also make it easier. Let's say if I'm an SME today. Today I don't have the 8-member team or a 6-member team. I do marketing, I do the purchase, I do the manufacturing. I don't have the ability to interface with the government. With this kind of a platform, my interfacing will be e-governed substantially. But if I might come back, and I think I made this point about the RTGS thing, I think it's very important because today the skill sets that lie with the Reserve Bank are not adequate in terms of what the digital world requires. And there is even the banks, for that matter, are very comfortable with their existing system where they enjoy the float benefit because that's where the income would primarily come from. Whereas if you want to deal with person to person, digitalization is very critical. Now, that requires interconnectivity. It requires clearing houses. And why I'm saying this is something that can happen very quickly. And companies like FINO, PayTech, others also, who are different platforms, they all would stand to benefit payment banks. That should be, today the banks as NPCI shouldn't be the only platform. There should be, like other countries also, you have connectivity, which is there with the digital world also.
Right.
You take what happened here in the 90s, what the NDA did, government. The major revolution that happened from the telecom world, DOT, etc., disappeared. And then you suddenly had the TRAI. And what's that done? But with the new system, we have to be very careful that the new entrants are not blocked. For instance, like Geo would have been blocked or by, let's say...
You're saying the new entrants in the banking space, payment
space?
No,
or in the payment space.
Okay.
In the payment space.
So you're saying make life easier for everyone so that they can all come and
24/7.
Yeah.
Plus the other benefit.
But there are concerns about security, there are concerns about risk and so on, right? I mean, finally, because this is people's money.
Correct. Now let me put it
and
this.
I'm going to come to that too, Rajeev.
Yeah, let me put it this on a scale of 0 to 10. Today, if I want to trace in a cash society, it's to a particular extent I may be able to trace cash. Let's say I might be able to do it up to the extent of 4.5. But on electronic transfers, or let's say on this digitalization platform, you'll be able to trace almost till about 8, I would say. And I know Rajeev is more competent, he can endorse that or give a view. Maybe it's not 100%, but it's distinctly superior to what you are today.
What we have currently used.
Yes.
Okay, Rajeev, let me come to you on that. So, as we move forward, we accept that we have to use new, transfer platforms, new ways of transferring money, whether it's business to business, business to business, and individual to individual. What are the risks today, and to what extent are we prepared with technology, as a country, as a culture?
So before I get on to that, I just wanted to add one point to what was being discussed earlier.
Yeah.
So there's one aspect of the customer being able to pay electronically. The other is the willingness of the merchant to be wanting to accept something other than cash.
Yes, yes.
Which will mean that the network will come into play, and wherein the suppliers of the merchant also need to agree that they will accept something other than cash and only take payments in electronic form. I think once the GST is rolled out, it will streamline some of the anomalies which exist in the tax structure today, and actually actually create an incentive for people to accept that electronic payment. So I think the whole chain has to become electronic rather than the first leg, because there has to be a pull rather than a push from the customer side. So that is one conversation I think which really needs to happen. In terms of security and risk, I think what we're talking about is banking, and banking by design has always endeavored to keep the customer money secure. So one is the security of the physical money, the other is security of the data systems that the bank has. I think in terms of payment banks, the Reserve Bank regulation clearly articulate that the customer money is never at risk because it is invested in Government of India security. So that customer money is always protected. In terms of data security, there are very robust frameworks already in place which ensure that the data of the customer is protected and there can be no manipulation. Of course, we are not saying that the world will become 100% perfect, but the degree of error or chances of error is reducing dramatically, and it's always a chase which goes on. But I would say, as we stand today, the customer money is reasonably well protected, both from the financial risk and from the information risk.
Right. Okay. So let's sum up very quickly. So we've got, you said, 90 days of trouble or pain ahead, and after which things should improve. The new normal, which comprises, let's say, some amount of cashless, maybe less amount of cash, and maybe more ease of transactions, maybe more velocity of money. What's it going to look like?
Well, it's going to increase liquidity in the market. That's one. As far as I'm concerned, it's going to reduce the cost of money, which is a part of the process.
Are you saying that because you're expecting an interest rate cut as well?
No, I'm not saying that. That will be a little premature on my part. But because of the steps that the government has been taking, and mind you, if I might just step back a little for a second, this is not something that has happened overnight. The cashless society, steps have started to be taken a year and a half ago, and I can share this with you that there has been a very clear strategy. The UPI launch, the demonetization is only a block in that direction. GST, as Rajeev said correctly, what that would do is all this will reduce cost of money. So I'm seeing that the steps that have been taken, although CRR has sucked out the liquidity just now for the time being, but overall it will increase liquidity, and as long as that transmission happens of the interest rates, then the customer will stand to benefit.
Right. And that's always a good note to end on. We've run out of time. Thank you so much, Mr. Premnarayan. Thank you, Rajeev, for joining me. We've come to the end of the show. We'll be back next week, same time. Thanks for watching.